Hi, my name is Christian Waldegrave, Head of Research at Teekay, and this is our tanker market update for December 2022. Now, as we enter the final month of 2022, it's perhaps worth reflecting on what's been an extraordinary year for the tanker market. At the beginning of the year, tanker rates were quite depressed levels, following one of the worst year for freight rates in living memory during 2021. Now, we did expect rates to gradually recover through the course of the year in tandem with rising oil demand, and as OPEC unwound the supply cuts that it put in place in May 2020. However, Russia's invasion of Ukraine in February changed the picture completely and led to a redrawing of seaborne trade routes that has little parallel in recent history. Now, these changes have led to an increase in average voyage distances and therefore an increase in tonne-mile demand. And that has translated into much stronger tanker rates from March onwards. Now, these changes have overwhelmingly benefited Aframaxes and Suezmaxes due to the load regions involved, with VLCC rates lagging for much of the year. In fact, Aframaxes have been the best performing asset class during 2022, with rates hitting record highs during November. The main catalyst for these changes, of course, has been a reduction of European imports of Russian crude oil. So if we look at the start of the year, the EU was importing about 2.5 million barrels a day of crude oil from Russia. This had fallen to a little over 1 million barrel per day as of November. And as of December 5th, that has fallen to zero now that the EU ban on Russian crude oil imports has come into effect. Now, as European imports of Russian crude have fallen, Europe has had to replace this oil almost barrel for barrel with supply from elsewhere, which has predominantly come from the US Gulf, West Africa, Latin America, and the Middle East. And now all of these regions are much further away than Russia. For example, a typical Russia to Europe cargo, such as Primorsk in the Baltic Sea to Rotterdam, is 1,100 miles or 4 days of sailing time, whereas Houston to Rotterdam is about 5,000 miles and 17 to 18 days sailing time. And post December 5th, now that the EU can no longer buy Russian oil, we expect that European imports from these regions will continue to grow, which will support tonne-mile demand. Lastly, Russia has had to find new outlets for its oil that it was previously selling into Europe. Most of this oil so far has been placed into Asia, primarily to India, on a mixture of Aframaxes and Suezmaxes. Chinese imports of Russian crude have gone up, but only by about 0.2 million barrels per day. However, as Chinese demand recovers through the course of next year and their imports increase, we do anticipate that China will start taking more and more Russian crude, especially if it's attractively priced. Now, looking at the net impact of all those changes on tanker demand, the decrease of Russian volumes into Europe has led to a reduction of about 10 billion tonne miles per month. However, that's dwarfed by the positive impact of growing non-Russian volumes into Europe, which has created about 19 billion tonne miles per month, and growing Russian exports to Asia, which have created about 46 billion tonne miles, for a net change of 55 billion tonne miles per month. For context, total crude oil trade at the beginning of the year was around 860 billion tonne miles. So that increase equates to an approximate 6.5% increase in tonne miles since the start of the year. But given most of this change has happened in the mid-size segments, the impact on Aframaxes and Suezmaxes has been far more pronounced, and that explains why the rates in those segments have been the strongest in the tanker market. So that's a snapshot of what's happened in 2022 to date, but the bigger question is what happens next? So to recap, there are two new policies that came into effect on December 5th. Firstly, EU countries can no longer import Russian crude oil by sea. And secondly, any other country that wants to import Russian oil must do so under a price cap of $60 per barrel. Otherwise, they'll not be able to access the fleet of ships that are financed and insured through EU and UK markets. So what does this mean for tankers? Well, firstly, the fact that the EU countries can no longer import oil from Russia means that they'll have to source replacement barrels from elsewhere for that last million barrels per day or so that they were still importing from Russia up until December 5th. And that's most likely to come from the Middle East and possibly Atlantic basin producers as well. And as discussed, those regions are all further away from Russia. So that is going to continue to create additional tonne-mile demand in the tanker space. Secondly, Russia will have to find additional markets to sell its oil into, most likely into India, China, and Turkey, which have been the biggest buyers of Russian crude over the last few months. However, it may take time for all of those barrels to be absorbed into Asia. And there's also a question mark over whether there is sufficient tanker capacity to transport this oil if countries do not abide by the price cap and therefore cannot access the fleet of ships that is insured through the Western markets. I think at the moment, just 3 or 4 days into the ban, it's a little bit too early to tell what will happen to Russian oil exports. We have seen in the last couple of days that Russian exports have dipped, and we could see a period of lower export volumes out of Russia as the market adjusts to the new realities. However, over time, I think we do expect that the market will find a way to move that oil and it will get absorbed, again, creating additional tonne-mile demand. It just might take a few weeks and months for the market to adjust to that. So what does this mean for the rate outlook? In short, we expect tanker rates to remain quite firm as we head into 2023 due to the positive impact of longer voyage distances. However, there's bound to be some volatility and some periods of weaker rates as the market adjusts to the new rules around Russian oil exports. And we can't forget that there are other factors at play as well, such as the global economy, which is going to be starting next year on a kind of a weak note. The state of COVID lockdowns in China, we're still seeing extensive lockdowns, although it does seem that the restrictions are starting to be eased back a little bit there. And also OPEC production policy. And all of those things could combine to cause rates to fluctuate through the course of the year. Now, looking even further ahead, we continue to be encouraged by the very positive outlook for tanker fleet supply, with some of the best fundamentals we've seen in several decades. 2022 is on course to be the lowest year for new tanker orders in 35 years, which is very unusual given the strong freight rate environment. But high newbuild prices, which are the highest since 2008 or 2009, a lack of shipyard capacity, I think some ongoing uncertainty as well over vessel technology and what type of ship to order and what type of propulsion system have been deterring owners from placing new tanker orders. Now, as a result, the order book, when measured as a percentage of the fleet, has fallen to just over 4%, which is the lowest on record. And if we look at the delivery schedule for mid-sized tankers, it really falls away quite rapidly, especially in 2024 and 2025, and especially the Suezmax segment, where there are only 10 ships on order right now. In contrast, the shipyards themselves are pretty full through to the second half of 2025, with some yards even booking into early 2026. So as such, we expect that tanker fleet growth will remain very low over the next 2 to 3 years, with potentially zero or negative fleet growth in 2024 and 2025, as scrapping is expected to outweigh deliveries into the fleet. So this could set up the tanker market for an extended period of firm rates, particularly as the demand side continues to look positive due to longer voyage distances and growing demand for oil. In sum, we're ending 2022 in what is probably the strongest Aframax tanker market ever seen. And although the future is uncertain and there's bound to be some ups and downs along the way, we do think that the market will remain firm into 2023, with the potential for a much more extended period of strong tanker rates given the positive fleet supply outlook. So that's our tanker market update for December 2022. I just wanted to wish you all a happy Christmas and a happy New Year, and we'll speak to you again in 2023.